It's What the Duck here, also known as MetaMatt, and welcome to PBU Lite. Make sure to check the description of this video for the class handout. This class is going to be an all-in-one how to get started in the stock market class. I know that the world of stock trading can seem daunting at first, and honestly, it's okay to feel that way. We all did at one point. Trust me. We all start somewhere, and even the most successful traders started out as beginners. Trading is a skill that takes time and practice to master. It's important to approach it with a long-term perspective and think about building a portfolio over time. Don't worry if you don't immediately see success. 90% of traders quit trading after 1 year, and a lot of them quit because they don't see immediate success. Some of the most common reasons are lack of knowledge, insufficient capital or risk management skills, emotional trading, unrealistic expectations, and the inability to adapt to changing market conditions. At Pennybois University, we will help you get started by setting realistic expectations and teach you how to protect your capital using risk management skills. We'll provide you with the knowledge that can help you become part of the 10% that do not quit. Educating yourself about the market and different trading strategies can help you make informed decisions and reduce your risk. But you don't have to go it alone. Seeking out help and advice from more experienced traders can help be a great way to learn and grow. That is the first step of being successful in the market. You are already on that step right now, so you're on your way. That's right, you've taken your first step in your trading journey, so congratulations. With practice and persistence, you can achieve your goals in the market, and of course with the right education. So the first step is setting up your brokerage account. A lot of brand new traders use Robinhood because it's easy to use and user-friendly. They have step-by-step tutorials on how to set everything up and use it. However, a lot of veteran traders prefer Webull due to their advanced charts and other information about the market that it offers. So let's set up a Webull account. Step 1 is downloading Webull. So first go to your phone's app store and search for Webull, and then download it to your phone. Step 2 is signing up for an account. Open the app and click on sign up to create a new account. Enter your email address, create a strong password, and click on sign up. Fill in the required personal and financial information and then click on next. Review and accept the terms of service and privacy policy. And then next you will have to verify your identity. Webull will require you to do this by uploading a photo of your government issued ID and a selfie. Step 4 is when you fund your account. So click on account and then deposit. Choose the deposit method and enter the amount that you want to deposit. Now you're ready to start trading. However, as someone who's interested in trading, you might be eager to jump into the market and start making trades right away. I want to emphasize the importance of taking a step back and starting off with paper trading. Paper trading is a practice of simulating trades without using your own real money. It allows you to practice and test your trading strategies and techniques in a risk-free environment. It's basically a great way to practice. This is especially important when you're just starting out because it allows you to gain experience without the potential risk of losing a lot of your own money. Over 90% of traders lose money their first 3 months and quit trading. This is because they put their own money into the market, and because they were brand new, they lost it. It's easy to get discouraged and want to quit when you see your bank account going down due to trading. With paper trading, you aren't losing any of your money while you learn. And trust me, we all lose while we're learning. Think about riding a bike. We start off with training wheels so we don't hurt ourselves. Think of paper trading as training wheels. It's the perfect way to practice without hurting yourself and wanting to quit. Imagine going down a steep hill with no training wheels the very first time you ever rode a bike. Well, if you fell, you probably wouldn't want to get back on it. Well, that's the equivalent of putting all your money into the market before knowing how to trade. You're going to get hurt, and you're probably going to want to quit. Once you've practiced enough with paper trading, it's important to start off slow with real money. This means when you put in your own money, start with small amounts of money and gradually increase your investment as you gain more experience and confidence. It's important to remember that trading involves risk, and starting off slow can help you minimize potential losses and build a strong foundation for your trading career. It's the same way that in hospitals, they don't let interns do brain surgery their first month. Starting off small and gaining skills gradually is the safest way to go about most things that involve risk, including trading. Starting off slow, after all, is important because it allows you to minimize potential losses and build a strong foundation for your trading career. So now that you have a paper account, you probably want to know how to use it to practice taking our free alerts. Well, the first step is to go to pbalerts.com and log into your account. Once logged in, you'll have access to our database of alerts. You can sort them by date, analyst, ticker, and more. We have stocks, crypto, and options alerts. The entry is the price that our analysts are looking to buy the stock, and the targets are where they're looking to sell for profit. The stop loss is the price at which they're going to exit for a loss to protect their capital. You can use the upside, downside, and ratios to determine what the risk versus reward for the trade is, meaning how much you could lose if it hits the stop loss versus how much you can make if it hits the target. It's important to keep in mind that playing follow the leader with alerts is how people get burnt. The goal is for you to become confident in every trade that you take, as everybody trades differently. In Pennybois University, we will show you different chart setups so that you can confidently see the reasons behind the alerts so that you can play them properly. The next step is building a watch list. You want to have a plan as opposed to going into the market blind. One way to build a watch list is to start with the companies you're familiar with and interested in. Just write down the names of the companies whose products or services that you use or enjoy. You can also find alerts that are still in play to add to your watch list. Use the Webull platform to search for these companies by name or ticker symbol. You can add them to your watch list by clicking the watch list button next to their name. Another method is to look for companies that are making headlines or have potential for growth. Keep an eye out for news articles or financial reports that mention companies with strong earnings, new products, or expanding markets. Or you can check out blogs and resources like stockresearchtoday.com, which is a free website that shows you stocks that have long-term potential growth with due diligence and technical analysis done by veteran traders. Use the Webull news and analysis section to stay up to date on the latest developments in the market. Or you can follow MetaMat TV on TikTok, as I also post financial news there in 60-second bite-sized format. You can also use the screener tool to search for stocks based on specific criteria, such as market capitalization or dividend yield. In Pennybois University, we go over how to use finvizinvesting.com and other sites to help build your watch list. Once you build a watch list, you can start doing basic due diligence on your stocks now. So first, research the company's financials. Look at its earnings reports, balance sheets, and cash flow statements. Check for revenue growth, profit margins, and debt levels. Second, consider the company's competitive position in the market. Look at its products or services, its industry trends, and its competitors. Ask yourself if the company has a sustainable competitive advantage. And third, look at the company's management team and board of directors. The person steering the ship does matter. Check for their experience and track record and see if they have a stake in the company's success. Fourth, consider the company's valuation. Look at its price to earnings ratio, price to book ratio, and dividend yield. Compare these metrics to industry averages and the company's historic averages. Fifth, look at any legal or regulatory issues the company may be facing. Check for any lawsuits, regulatory fines, or investigations. And don't get me started on the charts. There is a lot that goes into researching stocks, which is why we have a team of analysts who do the hard parts for you. And in Pennybois University, we will teach you how to read the charts as well as the financials of the company and everything I just said. So I know it's a lot, but that's why we're here. It is important not to put all your eggs in one basket when trading. If you go all in on one stock and that stock doesn't work out, well, you could lose a lot of money. That's why it's so important to have a diversification plan. You can split up your portfolio into percentages. That way you know how much money to put into one stock without risking too much capital. You can do the same with stock sectors as well to diversify your exposure to the market. There are also different types of trades as well, such as options trades, swing trades, day trades. Some are more risky than others. So it's important to be aware of where you're allocating your money in your portfolio when it comes to different types of trades you make to manage your risk. The same goes for assets. Some assets such as NFTs, crypto, and penny stocks might be riskier than blue chip stocks. It's important to allocate your funds wisely so that you aren't putting too much money into risky assets or trades. All right, so now that you're all set up, the next step is buying and selling stocks. We're going to use Webull for this example. First, select the stock you want to trade from the watch list or search for it using the Webull platform. Next, choose the type of order you want to place. You can choose from market, limit, stop loss, or stop limit orders. A market order is an order to buy it or sell a stock at the current market price. This type of order guarantees execution but does not guarantee the price at which the trade will be executed. So these are typically executed immediately. A limit order is an order to buy or sell a stock at a specific price or better. This type of order provides price protection but does not guarantee execution. A buy limit order will only execute at or below the specified limit price, while a sell limit order will only execute at or above the specified limit price. A stop loss order is an order to sell a stock at a specified price to limit potential losses. This type of order is triggered when the stock price reaches the specified stop loss price. Stop loss orders are typically used by traders who want to limit their downside risk. A stop limit order is a combination of a stop loss order and a limit order. This type of order is triggered when the stock price reaches the specified stop loss price, and then a limit order is placed at a specified price or better. Stop limit orders provide both price protection and control over the execution price. So enter the quantity of shares that you want to buy or sell and the price you want to trade at. You can also set a time enforced option such as good till canceled. This type of order, or GTC order, remains in effect until it is either filled or canceled by the trader. So this type of order is useful for traders who want to maintain a position in a stock over a longer period of time. So review the order details and make any necessary changes, and once you're ready to place the order, click the Place Order button. Confirm the order details and click Confirm to place the order. You'll receive a confirmation message once the order is executed. Everyone always says, make sure to lock in those profits. But what does that actually mean? Well, when your trade gets to your first target, you can sell a portion, for example, 75% of your position for profit. That way you're ensuring that you made money for that trade. Some traders will use this method to sell their initial investment, meaning what they initially put into the stock, and let the profits ride, meaning that they are only risking the profits they made from the trade by selling, if the stock was to go down. You can also use stop losses or trailing stop losses when you're up on a trade to ensure that you sell for profits. By locking in some profits, you are ensuring that you made money on the trade no matter what happens next. This allows you to protect your capital and reduce your overall risk. When traders don't lock in profits, they may become emotionally attached to the trade and have a hard time making rational decisions. By locking in profits, you remove some of the emotional attachment, allowing you to make a better trading decision. Allowing the rest of the trade to ride with a trailing stop loss allows you to potentially capture even more profits if the stock continues to move up. This is known as letting your profits run and is a popular trading strategy used by many successful traders. By using a trailing stop loss, you can limit your potential losses in the trade if the stock starts to move against you. This allows you to protect your capital and minimize your risk. It is important to track your trades and your progress so that you know what you did right or wrong. Use a notebook or software that allows you to easily organize your notes by stock, date, or other relevant categories. This will help you quickly find the information you need later on. As you conduct research on potential trades, take detailed notes on key metrics such as earnings reports, revenue, and industry trends. This will help you make more informed trading decisions. After making a trade, keep detailed notes on your entry and exit points, profit or loss, and any lessons learned. This will help you identify patterns and improve your trading strategies over time. Visual aids such as charts and graphs can be very helpful for stock trading when it comes to tracking prices and identifying trends. Be sure to take notes of important levels such as support and resistance levels, as well as any significant price movements. Take time to regularly review and update your notes to ensure that they are accurate and up to date. This will help you make more informed trading decisions and avoid making costly mistakes. Also, once you get the hang of trading and start making profits, it's important to keep in mind that bigger portfolio sizes come with bigger risks and involve a lot more emotions. That's why some traders take profits out of their trading account and put it into their bank account or savings account, or even long-term investments to ensure that they aren't getting too ahead of themselves. We are learning new things every day as traders, both about the market and ourselves. That's why it's so important to never stop continuing your education in the market. And Pennybois University is just the place for that. So I hope to see you all there, but until then, as always, I hope that you all make some bread.